Welcome back, and today we're going to take a look at 4 different stochastic trading strategies. I'll show you exactly how to trade them, how to find the best trades. I've included a lot of special tips using the stochastic, and at the end I have included a huge charting special. So make sure to stick around until the end and I will show you a lot of practical tips that you can use in your trading. A lot of traders always ask me, do indicators work? And they will say things like, price is the king, you only need price. And I can only always refer you to Marty Schwartz. Marty Schwartz was featured in the Market Wizards. He wrote the book Pitbull Champion Traders, which is my absolute ultimate all-time favorite trading book. I will link it in the video description. He won the World Cup Trading Championship 4 times. He turned, I think, 40,000 into 20 million US dollars. And he was using indicators and he was sharing his approach about indicators and explaining how he used it. So I would really recommend that you approach this video with an open mind, and then you're going to really appreciate the power of indicators and see how they can complement your trading. So let's start with the first stochastic strategy, and we're gonna do the overbought riding. And this is gonna something that will, for many people, completely challenge their way of looking at indicators. And many people believe that when the stochastic is in the overbought or oversold territory, so over 80 or below 20, they believe that the market is gonna reverse. But in reality, exactly the opposite is true. When the indicator is above 80, it doesn't mean that the market is going to reverse and go down. It means that the market is in a very, very strong trending environment. And the last thing that an indicator or the stochastic above 80 suggests is that the market will reverse. What this means is when the stochastic is above 80, it means that the price analysis is giving the result that there's a huge and strong trending market. And the last thing you should do is go against it. You should go with the momentum. You should go with the overbought. So when the stochastic is above 80, don't look for shorts, look for long trading opportunities. So this is a really, really important piece to the puzzle. I would recommend that, for example, here we are on the 1 hour chart, and this is a 4 hour stochastic, and I will show you in part 2 how to completely set this up on your charts as well. But for now, what I want to highlight is that the higher time frame stochastic, this one comes here from the 4 hour, gives you really a nice proper multi-time frame, higher time frame analysis. And you can see here, when the stochastic is below 20, the market is a strong downtrend. You don't want to go long here, obviously, because you will just completely wreck your trading account. You want to go short. The same is true when the stochastic is over 80. You don't want to go against the stochastic. You want to go with it, because you can see the market just kept going and going and going. Why? Because a stochastic above 80 does show that there's a strong bullish trend. When you look at the stochastic formula, there's nothing that would suggest that a high stochastic means short. Exactly the opposite is true. When you go into the stochastic formula, it shows you that a high stochastic means a very strong bullish trend, and you should not fight that, because you are going to lose your trading account. And when the stochastic is below 20, look for shorts. The market will keep going against you and against you and against you if you try to find the stochastic, because this is not what the stochastic was intended to do. The stochastic shows trending strength, and overbought and oversold are the strongest signals that the stochastic will give. Next, we're going to take a look at the stochastic breakout reversal. And here we're going to learn when it is okay to actually go against the overbought and oversold. But we are going to use confluence, and we're going to use a proper multi-time frame chart analysis. So first of all, what I would always recommend is when you see such a very tight channel on the stochastic where you can draw trend lines connecting the highs and the lows, do that, because that is an important and a strong signal. First of all, such a channel means that there's a strong trend going on, as I've just told you. An uptrend comes with an overbought or an overbought market, a downtrend with an oversold stochastic. So a very, very important piece of information. However, we are not going to do anything, or at least we're not going to go short, as long as the market is here trading in the stochastic channel. What we also can do is we look for patterns. So here we can, for example, see a trend line. We connect the lows, we get a very, very nice trend line. Here's our channel. And when you see that the trend line is broken, the stochastic channel is broken, and you have a strong momentum candle as your breakout signal, then you may look at a very, very important price and trend change point of the market. It doesn't automatically mean that you should go short here, but it is a very, very important piece of information that this ongoing uptrend is probably over. So if you are long and if you have been trading maybe the overbought riding approach that I've shown you in the beginning, then such a signal can help you time your exits a little bit better. And a little bit more waiting can then maybe even give you signals into the opposite direction of the trend. So this uptrend was over when the channel was broken, when the trend line was broken. Then you have your first consolidation in a potentially new downtrend. We don't know yet, but the market has broken into a new low, so it made lower lows. And when you see a breakout through the lows here, we have also completed our first lower high. And this, based on general market theory, means that you are now in an overall downtrending scenario. Lower highs and lower lows indicate that. And you can see here is where the breakout occurred. So we are breaking those lows here. We are making now a confirmed lower high because the market, after making this move here, wasn't able to push higher. We are making another lower low because we are breaking through the support level. And now you're looking at a very, very important piece to the downtrend that we're here anticipating. So the uptrend was over when the channel was broken, when the trend line was broken, and we don't want to be too early in a new trend because usually you will just burn your fingers if you try to catch a falling knife, as we say. But what you want to do is you want to wait for additional confirmation. And now we can stack the confluence really in our favor. We have a lot of information here on our sides with the lower highs, the lower lows. We have a breakout out of this nice range. And now we are anticipating a downtrend. And you can see this is exactly what happened. The market accelerated to the downside. And you can very, very nicely see how we can use not only the stochastic, but our whole trend analysis in a very meaningful way and put all of the pieces together. I have traded divergences for probably around 10 years, and we can also use the stochastic to create a very, very interesting stochastic divergence strategy. So the basics first, a divergence just means that the indicator and the price action are diverging. They're doing two different things. So in this example, you can see that when we look only at the price action is actually making higher highs, right? So it looks like a healthy uptrend. However, the indicator stochastic is already indicating that there is not a lot of bullish momentum behind this final push here. And you can see the indicator here, the stochastic, is just around the 50 level. It's not even coming close to where the previous high of the stochastic was. So this is a significant divergence here. Very important that a divergence doesn't automatically mean that you are looking at a trend reversal. First of all, what a divergence means is that the previous trend that was playing out is likely to be over, or at least going to go into a long sideways consolidation phase. So if you see a strong divergence, and if you're in a trade that would require the price to keep going, it's often a good idea to, if you don't want to cut your whole position, at least scale out partially. However, what we want to do now is we keep following the price action. We can now draw here a support and resistance level. Here was the divergence. You can see we are already making lower highs. We also have a very, very nice trend line. The trend line has been broken, and here you can see we have this dotted support line, and now we are breaking into a new low. So the indicator divergence happened all the way back here. And the indicator divergence was just the first piece to the puzzle. It signaled that this previous uptrend was over, and now what you would be doing as a trader is you would start following this price action. And once you see that such a nice pattern unfolds, once we can really nicely apply our technical tools, support, resistance, trend lines, and then actually see a breakout reversal signal, then you are going to position yourself into the new trending market. And the way you want to do that really depends on your preferences. Do you prefer the breakout approach, or do you wait for the first pullback? That is totally up to you. And there are pros and cons around the different scenarios and approaches. I made videos about that. But generally speaking, when you see that the market is making lower highs and lower lows, there's a very good chance that you're looking at the beginning of a new downtrend. And this is what happened. Here's the divergence, here was the breakout, and you can see the market did sell off initially. And as I've said so many times in so many other videos, the market and a trend will not move in just one single line. However, what you will see is this wave rhythm. The market goes down, it goes up, it goes down, it goes up. And if you are looking here at a downtrending scenario, you can see here we have a very strong downtrending trend wave. And then here we have our first real consolidation in the downtrend. And again, we are able to not only see here a divergence, we can connect this high and this high. And you can see when we look at the indicator, we have lower highs, but we are also able to confine our stochastic in a triangle, and you can very nicely put here a trend line on your indicator. In the example before, I showed you how we use a channel, and now we can find a trend line and a triangle here on the stochastic. And again, you want to make sure that you wait for the complete and the full breakout of such a pattern, and then you are able to find trend following continuation signals. Again, using divergence concept, breakout concepts, and the stochastic here as well. So the next approach is a stochastic pullback trend following strategy. And we are going to use a moving average here. You can see the blue line. This is the EMA 50 period from the 4 hour, and the price action is the 1 hour. Again, in just a few moments, we are going to reach our charting special, part 2 of this video. And then I will show you exactly how to set your charts up and provide a lot of tips around those indicators. And what the moving average does is it helps us pick the direction. So the direction should always come from the higher time frame, because the higher time frame really provides you the bias, and then on the lower time frame you try to time your trades into the direction of the longer term trend. So as long as the market is below this blue line, we are in a short market. We want to look for short entries. We are in a bearish environment. So what we do here is actually, in this case, we are going to use those dips into the overbought to try to time pullbacks. And again, just because the market is in overbought, we are not going to go short. Very, very important. It means just that this is a first heads up, and we're going to look for additional confluence. But this is a good way of helping you to screen for trading opportunities. Once you are able to define the higher time frame trend, then you are able to define and find those pullbacks. You should try and start following the markets. A good way and a good approach to do that is also look for patterns for better trade timing. So in order to add a little bit more confluence to your approach, once you see that you have here the overbought dipped like here or here and here, you are going to try to find trend line support and resistance levels, and then you can use that for breakout timing. Obviously, not everything would have worked here, so you would have gotten out probably a nice trade here. Here probably not so much because the breakout immediately was reversed. Here a very nice trend following entry, and here this didn't trigger until here. So you can see nothing works 100% in trading, but that's not the point. What you really want to make sure is that your winners are larger than your losses. Then obviously you don't even need a win rate of 100%, not even close. But this is a great way of trying to filter trades. And here is another step-by-step example. So this is, again, we are on the 1 hour time frame, and the moving average is coming from the 4 hour. You can see the market is back into overbought. It's reaching the moving average here. We are drawing our support level. The market is breaking it with a very strong candlestick. So we have this engulfing candle previously, and then the breakout candle here breaking the lows. This could have been used as a potential trend following opportunity. Targets are often used here as the previous lows, and then you can see this is what happened afterwards. So again, a very, very nice approach that you could use if you are into the stochastic, or even if you're not, try it out, see what the stochastic can tell you about the market, and then it may enhance your chart reading abilities. So now let me help you with a few tips on how to set up your charts like I used in the video, and I'm using TradingView as always. And first of all, we can just go to the indicators. Here we type in stock, and then stochastic comes up. We click it once, then it is here. And you have so many options here in TradingView. When you hover over here, you can see you get the settings symbol or icon. We click on it, and now we can do so many things. First of all, what I always like to do is remove the background. I usually like to color them differently, so I make the K green and a little bit bigger. I make D red and a little bit bigger, so it's really obvious. And that is for styling. And now you have a few options. You have K smoothing and the D smoothing. So there are usually three different settings that are used for the stochastic. And the three different stochastic settings are displayed here. So you have your fast approach, which is often used for day trading. It's a combination of 533. The medium one for either day trading or short-term swing trading. It's just a very nice medium and average approach that works for all types of traders. It's 1433, and then a much slower approach for the stochastic is 2133. And you would just put it in here. You can see 1433 is what I used mostly for the video as well. And you can also, if you want to have it from the higher time frame, you go to time frame. Same as chart obviously gives you the one that you are currently on, but you can also put in the daily. So this is how I used it from the daily chart. I've also used a higher time frame moving average, so we can just MA here and moving average comes up. And again, we want to open the settings, and now you have so many different things. I always use the 50. I just found it's the most reliable and works across all the time frames, across all markets. And again, if you want to have a higher time frame moving average, you just default it to daily. And now if you go to any lower time frame, you will always have your higher time frame daily 50 period moving average wherever you go. And this is how you can set up your charts on TradingView. It's very, very simple and it's very effective. So I would really recommend take the time to study the stochastic. It's a great indicator that is very versatile, and it can help you in so many different areas and aspects of your trading. I think it's very important that you know how your indicators are calculated, and especially if you have the idea that indicators don't work, which obviously is completely false. It is very important that you take the time to understand what is an indicator actually doing, because it will really open your eyes and show you that indicators do work, because the only thing they do is provide you with price analysis, and then it's up to you to use it. So indicator stochastic calculation, I keep it very simple because that's what it is. And in this example, I set the stochastic to 533, so that's the fastest approach. And what it does is looks at the last 5 candles, and it looks at the range of the 5 candles, so the high and the low. Here in this example, the high is 100, the low is 60 of the range. And it looks at the close as the final point. So within the 5 candles range, the close is at 95, the high is at 100, and this means that it is 88% at the highest point of the range. If you do 100 minus 88, it's 12. I hope you all agree on that. And this means that it's only 12% of the highs. So it means that within the last 5 candlesticks, the price pushed really strongly upwards and then closed almost at the top of the last 5 candles. So the market is pushing higher. This is why it's so important to understand, because it shows you that when it's overbought, it only means that the market is super strong, because the price closes at the upper end of the range. It has nothing, zero, to do with the market is going to reverse. Here, the opposite side, you can see we have the stochastic of 17, 100 minus 17, 83. So you can see the high of the range of the last 5 candles is 80, the low is 50, the close is 55. It means that the market closed 83% away from the highs and 17% to the lows. So again, stochastic of 17 only means a very strong downtrending market, because the market was able to close at a very low point. And I hope this really helps you to understand what you're actually looking at for your indicator, because this will help you understand why so many traders struggle with indicators, because they've actually never taken the time to understand the trading tools that they use. And obviously then you're going to use it in a wrong way and you're going to lose money, and then you're going to attribute your losses to the indicator that was not working, but actually you just have no clue of how to use the indicator in the right way. So it really helps to look at the indicator formulas. Indicator formulas in general are very simple, so take the time, pull up your indicators and try to study them.